Okay, finally, we'll talk about the requirement to account for uncertain tax treatments. So the relevant pronouncement is WSB Interpretation 23, which requires companies to recognize any uncertainty in any tax treatments. So it applies from 1 January 2019. And when you work out whether or not something is uncertain, you need to assume that that treatment will be audited by the tax office and they know everything you know, have all the documents which you have. So to work out whether or not you need to recognize any uncertainty into your financial statements, you need to ask, is it probable? Again, there's more than 50% chance that the ATO will reject your position. So most people would say that, look, it's really, there's no way I will recognize anything that the ATO would reject, will probably reject. You know, if there is uncertainty, it's most likely I'll get a private binding ruling if required. But let's say you have recognized a position where there's more than a 50% chance that which you have assessed that the ATO would reject, then you need to calculate that uncertainty and recognize it into your financial statements. So there's a two approach to that. One is the single most likely amount that you'll settle with the ATO, or you can take an average of expected outcomes and recognize that into your financial statements. So each year you need to assess that position and recognize any changes as a result of the reassessment. Okay, so if you have recognized any uncertainty in your financial statements, then it's likely to create volatility in your tax expense number. It's also going to impact your effective tax rate as well. So it's more likely for accountants, if you're unsure whether or not this treatment is uncertain, you probably need to work with your tax team or your legal advisors, or seek a private binding ruling from the ATO to remove that uncertainty. So it probably would be an increased use of private binding rulings for those treatments where it's really unclear whether or not the ATO would reject that position. So that is all I wanted to cover this morning. As a recap, we spoke about some of the tax changes to consider when performing your tax effect accounting calculations. We look at the tax effect accounting concepts, and we looked at more complex accounting treatments that are required under the WSB 112. So if you require any assistance, please feel free to reach out to your SW relationship partner or managers. So we'll now check if there are any questions. We got 5 minutes for any questions, if anyone have any questions. I've got a question from Lee Swan. Do you see any future changes to the ACA allocation going forward regarding tax consolidations? There have certainly been changes over the years in relation to how we do calculate the ACA amount, including dealings with future deductional amounts and WIP balances. I'm not aware of any changes that has been announced at the moment in relation to ACA calculations. And one thing to note is that when you do perform your tax effect calculations, you take into account tax legislation which have been substantially enacted. So probably something that has received royal assent rather than something that has been announced. Okay, so I might give you back your morning. Thank you again for joining us. We'll share with you the slides and give us a couple of days to publish the video and reach out to your relationship partner or manager if you require a link to that video. So thank you very much and have a great morning, everyone.